Welcome to Accounting in Focus. In this video, we are going to talk about bad debt, what bad debt is, when you record bad debt, and a couple different general methods of recording bad debt. So first off, what is bad debt? Well, imagine that you had a sale to Mr. Smith. And Mr. Smith owes you $500, okay, because he purchased something from you. So right now, Mr. Smith has an accounts receivable balance, AR Mr. Smith, has a debit balance of $500. And after trying to collect your money for Mr. Smith for, I don't know, maybe 6 months, he doesn't return your phone calls, doesn't respond to bills, and decides he's not going to pay you. So what are we going to do? Well, we decide that this account is now uncollectible. And therefore we're going to write it off. Okay, so we're going to write off the bad debt. Now, there are a couple different ways you can do this. One method is called direct write-off. And direct write-off means that as soon as we decide that Mr. Smith is not going to pay his bill, we're going to directly write it off. Okay, so the journal entry for that, for direct write-off, would include an account called bad debt expense, and because we have expense at the end, this is an expense account. Let me put my DR and my CR here. Okay, and we're going to debit bad debt expense because the normal balance and expense account is a debit. And then, remember, we said that Mr. Smith is not going to pay us. We're deeming it uncollectible. So we need to reduce his balance down to zero and say Mr. Smith no longer owes us this money. So because I have a $500 debit balance, to get rid of it and bring it to zero, I'm going to have my accounts receivable, Mr. Smith, $500 credit. So that brings his balance to zero, and I'm recording bad debt expense. Now, the reason that I don't use sales for this, because you would kind of think, well, if he's not going to pay us, then why don't we just credit accounts receivable and debit sales? Well, we want to preserve the sale because especially if we sold him a product, we're still going to have the cost of goods sold for that product. And so we want to maintain the sales, right? Because this is a different part of the company. This has nothing to do with whether our salespeople are doing well or not. This is whether or not our collections people are able to collect. Okay, so we're going to keep it separate, so we're going to use this bad debt expense. Now, there are a couple issues with using the direct write-off method. There are two principles that are very important in accounting. The first principle is called the matching principle. And the matching principle says we have to match revenue with expenses. So what happens if this transaction with Mr. Smith happened in 2012 and we make this journal entry in 2013? Well, that would violate the matching principle because we had the revenue in 2012 and the expense in 2013. So we're not matching revenue with expenses. The other principle that this might violate is materiality. And if you remember, materiality means that we're looking for errors, okay, or changes in amounts that would change decision making. Okay, would change decision. So if something's material and an investor or a creditor looks at it, it might change whether or not they decide to invest in our company or lend money to our company. So the reason that this might violate materiality is because we might say, okay, well, we're not going to write off anything in 2012 because we want our numbers to look really good, and we'll wait until 2013 to record all those bad debts. Okay. Where materiality says, hey, maybe we should record something for bad debt every year because we know that there's a good chance that things are going to, that some of our accounts receivable will be uncollectible. So the second method that we can use is called the allowance method. And in the allowance method, what we're going to do is we're going to create an allowance so that if we have bad debt, okay, if we have write-offs, we're going to take them out of this allowance. You can almost think of it as like if you have a checking account, it's kind of like overdraft protection, okay? And the way this works is if you think about accounts receivable, my accounts receivable balance is actually a whole bunch of accounts receivables. So we've got accounts receivable Abe, accounts receivable Ben, accounts receivable Sally. Let's see, Sally, accounts receivable Beth, right? We probably have hundreds of accounts receivables with somebody's name tied to it. Okay, and if you look at our, if we add up everybody's balance, this gives me total accounts receivable. Right, so maybe Abe owes us 500 and Ben owes us 200 and Sally owes us 300 and Beth owes us 100. So that's that's $1,100. Now the 1,100 is all you're going to see on your financial statements. You're not going to see everybody's individual balance. So what the allowance says, it says we think that some portion of this 1,100 is going to go bad. We don't know who's not going to pay us. Maybe A won't pay us, maybe Sally won't pay us. We don't really know, but we know that somebody's not going to pay because we looked at past history. And so we know that somebody's not going to pay. Therefore, we're going to create an allowance. Okay, think of overdraft protection, right? This is an allowance so that when somebody doesn't pay, we've already recorded the bad debt. And so under the allowance method, the journal entry looks like this. We're going to debit bad debt, just like we did before, and we'll say that it's 500. In one of my later videos, I'll show you how to do the calculations, but we'll just say it's $500. Now, because I don't know who's not going to pay me, right? So I can't say AR Abe or, it's AR Ben and AR Sally. I'm just going to use allowance for doubtful accounts. Sometimes you'll see it called allowance for uncollectible accounts. You'll see it called allowance, but the name that most of the texts that I've ever used, they call it allowance for doubtful accounts. So I'm going to credit that 500. Okay. Now, allowance for doubtful accounts. Let me change my color here. Okay. Actually, let me use yellow because I haven't used that yet. Okay. Allowance for doubtful accounts is a contra asset. Okay, which means the normal balance is opposite to a normal asset. That's why we credited the account 500. Okay, that would be the normal balance in the account. It's a contra asset, and it's linked to accounts receivable. So what you would see on your balance sheet, so imagine this is my, so if I was doing my balance sheet, I would have accounts receivable, and we'll just use the 1100. And then I would have less allowance for doubtful accounts, and I'm just going to use the 500 I have here. It's a really high allowance for that much in accounts receivable, but it'll work. And then you would say accounts receivable net. Okay, so anytime you see the word net, it means that it's an account less some other stuff. So accounts receivable net would be my accounts receivable balance less any amount. So I'm going to subtract the allowance for doubtful accounts. So this 1100, this is a debit, right? My normal balance on accounts receivable is a debit, less the $500 allowance. So my net would be 600. And again, that's a really high allowance for that much in accounts receivable, but you get the idea. Okay, so two methods, the direct write-off method and the allowance method. Okay, both use bad debt expense, but remember under the allowance we don't know who's not going to pay, right? So therefore we're going to use this allowance for doubtful accounts. Now, what happens when we actually figure out that somebody's not going to pay? Okay, so what happens if Beth doesn't pay? And we have to write off Beth's balance. Okay, well here's my, remember I've got 500 in allowance for doubtful accounts. Now I know who's not going to pay me, right? So I've got to write off Beth's receivable, and I'm going to use up some of this allowance. So if I look at my journal entry, it would have accounts receivable and allowance. Okay, remember that's allowance for doubtful accounts. Now I need to bring her accounts receivable to 0, so I'm going to credit the accounts receivable. And then I'm using up some of this allowance. Remember there's $500 in my allowance account because I credited the account here. So I'm going to use up some of that, and I'm going to debit my allowance. So now what effect does that have on this here? Okay, well let's look at my new accounts receivable balance. It was 1100. Then we credited 100, so my AR is 1000. And my allowance, it was 500, but I used up 100 because I debited the account, so 500 minus 100 is 400. So my AR net is still 600. That's kind of cool, huh? It doesn't change the balance in my net receivable because all I did is say I went from I don't know who's not going to pay me to oh, now I know who's not going to pay me. So I'm reducing accounts receivable and reducing the allowance. Okay? Hope that helped.